Hi friends, in this market fall, investors are divided into two camps. Camp number one is investors who are right now panicking. They are exiting stock market. They are booking heavy losses and are really worried a lot. And then you have camp number two where investors are thinking that, you know what, this is a lifetime opportunity to build the wealth, because when the stock markets fall, valuations become really lucrative, and therefore it brings an opportunity to build the wealth over a longer period of time. I am personally in camp number two, and I see that this is a great opportunity, lifetime opportunity to build wealth for a long period of time. But if you are in camp number one, which is that you are worried about your portfolio, you are worried about losses, in the next 2 to 3 minutes, I am going to present you some data around the market falls that will give you a lot of relief. And not only a lot of relief, you might change your camp and you may start thinking that 2025 is a great year to start building the wealth for a longer period of time. Every word I speak will be backed by data. I am not going to do any nonsense talks that I see on YouTube videos. And if you like this analysis, the only expectation is that you like the video. Let me know in the comments a simple thank you. It motivates me a lot to bring such content to you at zero cost. With that, shall we get this video cracking? Let's go. What you see on my screen is Nifty 50 chart over the last 5 to 6 years. Now let's assume investor number one, just pre-COVID, just somewhere here, put in 10 lakh rupees in the stock market. Of course, he did not know that COVID is coming up and the market will crash. He is gone ahead and put 10 lakh rupees here. If he remained invested and did not panic during this COVID crash that we are seeing, then as of today, his 10 lakh rupees would have appreciated by how much? Almost 85%. This 10 lakh rupees would have become almost 18 lakh 50,000 rupees as of today. Now, as soon as he put in 10 lakh rupees, market started to decline because of the COVID fears. And let's say market fell by almost 15%, as you can see here on my screen. And let's say at that time, investor two thinks that, you know what, the market is fallen by almost 15%. It is indeed a great time to now start accumulating and start buying the dip. And he put in 10 lakh rupees at 15% fall. Now for this investor too, if you see, his 10 lakh rupees as of today has gone up by 116%. So 15% fall does not mean that his wealth is going to go up by incrementally 15%. In fact, it is gone up by 116%. And if you do the maths, investor one 85% and investor two 116%, almost 31% appreciation in the 10 lakhs is what this guy has seen, although the stock market fell by almost 15%. So his 10 lakh rupees would have become 21 lakh 60,000 rupees as of now, assuming that he also remained invested. But you know what? Market continued to fall during the COVID. And then when market fell by almost 30%, comes the investor number three, very smart investor. And he says, you know what? I've been patiently waiting now and the market has now fallen by 30%. Let me now put in 10 lakh rupees in this 30% fall. He does that. And as of today, his 10 lakhs would have gone up by 165%. Again, see the difference between the first investor and the third investor. Here 30% fall has not led to 30% incremental growth. It's gone up by 165% versus 85% that we saw in investor one. And therefore his 10 lakhs have now gone to 26 lakh 50,000 rupees. Now comes the final and the most smart investor who has found the bottom. Generally, it doesn't happen. Nobody can really tell you exact bottom, even if you go to somebody who's been investing in stock market for 30 years or 40 years or whatnot, right? Here, let us hypothetically assume that this investor 4 picked the bottom absolutely perfectly. He invested when the market fell by almost 38%. He put in 10 lakh rupees at that time. His 10 lakh rupees would have appreciated by 195%. His 10 lakhs would have become almost 29 lakh 50,000 rupees. Although the market has fallen by 38%, his wealth has gone up by 195% versus the investor number one, which saw 85% increase in wealth. My point is very simple here. When the market falls by 10%, 15%, 20%, and if you remain invested and in fact see that as an opportunity, your wealth is likely to go up over a longer period of time. That's what data is telling us. And if you also note here that all four investors actually made money irrespective of whether you are buying during the crash or you're buying at the peak. One of the biggest thing that you need to understand is that if you are sitting on losses, if your portfolio is in negative, and if you're exiting the stock market out of panic, you are going to lose money. That is guaranteed. But if you remain invested over 5 years, 8 years, 10 years, the chances of money losing becomes very, very low. In fact, you are likely to build wealth because India remains a structural story over a long 5-year, 10 years of period. And second point you will note here is that nobody can really predict the bottom. The market falls by 10%, 15%, 20%, 30%. Nobody can tell you exact bottom. Therefore, what you need to do is you have to look out for valuations. And that's where let me now present to you 3 indexes and let me speak about the fall of 10%, 15% does not matter. You do not invest your money thinking that this index has fallen by 10%. Let me go and buy the dip. No, that is a very, very bad strategy in my view. The good strategy here is you look at the valuations of a particular index or an asset or a stock. And when you think that valuations are now lucrative, that is where you take your bet. And this is because over longer period of time, markets move in the valuations trajectory, not in any sentimental play. They will look at the valuations and accordingly reward you. So in the remaining video, now I'm going to give you example of 3 indexes that have fallen, but more importantly, their valuations are very, very lucrative right now. Again, not a recommendation here you go and invest in these indexes, but the idea here is to present to you live examples of not to go by 10% fall, 15% fall, 20% fall. Have a look at the valuations and then decide whether this makes sense or not. If you like this point of view, I request you to hit the like button. Let me know in the comments a simple thank you. It motivates me to bring you some positive and data-backed analysis rather than doing some nonsense talks. With that, now let me move to index number 1. Have a look at my screen, Nifty 50. At the time of recording this video, Nifty 50 is fallen by around 14%. And you might be wondering that, Rahul, can this fall further? Can it go down to 15%, 20%? I created a separate video on Nifty 50 and I presented my view. In my view, 20% fall is unlikely. I presented a lot of data-backed analysis in this video. This video is still on my channel. You can go ahead and watch that video and you will understand that why I am saying that 20% fall is unlikely in Nifty 50. Again, I may be totally wrong here, but there is a point of view which is backed by data. Therefore, I would encourage you to go and watch that video. But coming back to currently, if it is at 14%, where is the valuations? I want to come back to valuations. So have a look at my screen and you will see that at the time of recording this video, Nifty 50 PE ratio is at 20. Is it a good valuation? Is it a bad valuation? For that, let's have a look at the history. If you look at the 5-year average PE ratio of Nifty 50, it is around 24.83. Right now, we are at 20.04, meaning that from a last 5 years perspective, Nifty valuation looks much better, much attractive right now. Also have a look at this screen here. Pink line is the PE ratio here. In the last 1 year, the PE ratio of Nifty has not gone down to 20. This is the first time that Nifty PE ratio has gone down to 20. And if you look at the last 5 years of data here, so for example here, if you see the last 5-year data, you will note that again, pink line is the PE ratio. Barely somewhere here, for example, it was at 20.40, but it did not go below 20. Again, have a look at this data here, almost 20.21 back in April 2023, did not fall below 20. The only time it fell below 20 was somewhere here, 19 PE ratio, June 2022. This happened for a very, very short period of time. As you can see, the Nifty started to go back up because the PE ratio was down below 20. Again, if you come back to COVID levels here, for example, in April 20, it fell down to almost 17.58, but that has happened only once. Again, market fell by almost 38% if I remember that time correctly. Therefore, my point is very, very simple. 20 PE ratio in the last 5 years, we have seen only 2 times. One is during the COVID and second is in June 2022. After that, we have never seen Nifty going down to 20 level. Again, can it go down to below 20 from a PE ratio perspective? Everything is possible in this world, but the data tells us that it is a rare situation. Therefore, in my view, Nifty 50 valuation looks very, very good right now. Now, when it comes to Nifty 50, I personally invest using ETFs. I do not go index fund route because I think ETFs are a great way to get the spot price. Again, I've spoken about that concept a lot in my videos. If you have not yet subscribed to my channel, request you to subscribe because these learnings do not come in one single video. When you watch 10 to 12 videos, all of a sudden you start to connect the dots and you see that massive value coming your way, right? Now, coming back to ETFs, a simple screener I have created here, and what I've done is I have looked at 3 factors when it comes to ETFs for Nifty 50. 3 months average volume, liquidity in the ETFs is the most important thing that you need to go after. Tracking error secondly, and expense ratio. And I have arranged them in the order of liquidity. Nifty Bs comes on the top, followed by SBI, ICICI Prudential. None of these are recommendations. This is not a promotion. All I'm trying to share here is the way I go ahead and look at the ETFs here. For example, ICICI Pru has got very good liquidity here. The expense ratio is 0.03, slightly better than SBI Nippon. and tracking error is also not very high, 0.03. You might want to split your money. Again, it is entirely your choice what you want to do whenever you want to invest in Nifty 50. I'm not saying invest right now. Point is very, very simple. Rather than looking at 14% fall of Nifty, I would say that look at the valuation and let valuation decide your buy or sell calls rather than just a 14% or 18% fall, because these falls make no sense. Valuations over a longer period of time makes 100% sense. Before I move to index number 2, if you want to learn investments practically and want to get almost daily basis insights so that you can make better investing decisions, you can consider joining my YouTube member community. I almost share on a daily basis insights that will help you learn investing practically. Also, the feedback of this community has been excellent. Simply go to my channel, press on join button, be my guest, or you will find the link in the description or in the pinned comments. With that, let's move to index number 2, which is even more interesting, which is Nifty Next 50. Have a look at my screen. You will see that in this fall, this index has fallen by almost 24% at the time of recording this video. Now, again, rather than thinking whether 24% fall is a good fall or bad fall, let's have a look at valuation. So the PE ratio right now is 21.2. If you look at the last 5 years PE average, that has been around 29.72. Right now it is at 21.18. In my view, it is trading almost 8 below than the normal average PE ratio in the last 5 years. Very, very good play in my view. Also, if you see my screen, the pink line is the PE ratio of the junior Nifty or Nifty Next 50. If you have a look at my screen here, the PE ratio right now is 21.18, and in the last 1 year, this is the lowest PE that we have seen. Okay. If I go back to last 5 years of data, you will note that only once here, somewhere here, it has come down below the 21 PE ratio, which is at around 17.77 in June 2022. It has touched around 21 here, but gone back up. Here again 21, almost 22 here, somewhere here, 21.96, gone back up. Very, very strong support at 21 is what we can see. Even during the COVID time, it did not go down to that route. Only once in the last 5 years, which is here in June 2022, it went down below 21. So it can happen. It's not that it has never happened, but my view is how many times has it happened in the last 5 years? Only once. So therefore, for value investors, analyzing this way makes a lot of sense rather than looking at only 15%, 20% fall. My last point on Nifty Next 50 is that Nifty Next 50, which is the stock number 51 to 100, is slightly different from Nifty 50 in the sense that the financial services allocation comes down to 23% here, while in Nifty 50, it is at around 34%. So there is a heavy concentration of financial services in Nifty 50, while Nifty Next 50 does not have that much of weightage to financial services. So from a sector allocation perspective, it is less concentrated. Is it a good thing or bad thing? It really depends on how financial services are going to play out in the next 1 or 2 or 3 years, depending on your time horizon. But I think you need to understand this point that from a sector allocation perspective, it is slightly different than Nifty 50. Again, you can see my screener here in terms of the ETFs for Nifty Next 50 here. I've gone ahead with 3-month average volume. I've arranged them in that order: tracking error and expense ratio. Have a look at these 3 factors and make your decision if you ever want to invest in Nifty Next 50. The third index I want to speak about is Bank Nifty. Have a look at my screen. This has fallen by almost 10%. And the reason I've included in this discussion is that 10%, 15%, 20% does not matter. One might think that this is fallen by only 10%, should I invest or not? Rather than that, I'll go with Nifty Next 50 because it has fallen by 25% or 24%. Again, I would reiterate that do not just look at the absolute fall. Look at the valuations, because valuations make more sense over a longer period of time. So let me speak about the valuation for Bank Nifty. So when it comes to Bank Nifty, typically you would look at the PB ratio more than the PE ratio. Now, if I explain to you why that is the case, then it's an entirely separate topic. I would need at least 2 to 3 minutes to tell you various scenarios of why we look at the PB ratio. At some point in time, I will discuss that. But coming back here, the PB ratio is at 2.1. Last 5 years, average PB has been around 2.61. Right now, it is at 2.14. It is lower than the last 5 years average. But if I show you the last 1 year PB ratio of Bank Nifty, again, have a look at my screen. Pink line is the PB ratio here. In the last 1 year, this has gone down to almost the lowest level, 2.14. In January also, it was very low at around same level, 2.13. But if you see the last 1 year, it is the lowest level. If you go to the last 5 years average, you will note that it has not gone down to that PB ratio. In fact, not even once prior to COVID. During the COVID, yes, it was consistently below 2.14. But after COVID, if you see, it has not gone down to this PB level. So it is very, very lucrative from a valuation perspective. Again, I'm not saying go and buy this. But what I've done here is I've presented you these 3 indexes. All 3 indexes have fallen by different levels. One was fallen by 10%, another one 15%, another one 25%. but all three from a valuation perspective looks very, very different, right? So do not look at the absolute percentage, look at the valuations. Now Bank Nifty is very, very different from Nifty Next 50 and Nifty 50 because here we are talking about 100% money being allocated to banking stocks. So for example, here stocks like HDFC, ICICI, Kotak Mahindra Bank, etc., PSUs, private banks as well, and therefore it is more concentrated. So whenever you're investing in such indexes, you really need to think about whether the financial services play is going to be very good in the next 2 to 3 years or whatever your time horizon is. Do not just blindly invest. You really need to think through whether you want to go with financial services or not is the key consideration here more than the valuations. Final point, here is a list of ETFs that I have arranged in the order of the liquidity, which is the last 3 months average volume, tracking error, expense ratio. You can do your own analysis. You can find your own ETFs or index funds, whichever you're comfortable with. But in this video, what I have tried to do is bring you the concept of valuation into your minds. Hopefully you've learned that concept now, and rather than now looking at the absolute fall, percentage fall, you will now also look at the valuations, and if valuations make sense, you would look to deploy your investments. Continue to say to you that market falls, you should not worry. Market falls are very, very normal. It is cyclic. Stock market cannot just continue to go up. It will come down. It will need a reason to just come down. Again, it will find another reason to go back up, because that's how stock market works. Remain invested is a skill that many people have not mastered. Through my videos, my intent is to bring this behavioral change that continue to remain invested. If you want to only invest for 1 year or 2 years, then go and invest in FDs, go and invest in debt mutual funds. There is a security there. When you come to stock market, do not expect overnight returns. There are a lot of people who say that you make money like this. You don't. You lose money. That's why FNO people lose money, because time is not in their side. Hopefully you like this analysis. Again, I would reiterate, keep calm, keep invested, keep rocking. I'm going to see you in my next video.